Hey guys, good morning. It's Julie. I'm going to show you some things with the JATS PT indicator. The This is the E-mini S&P 500 ES contract, the futures contract on a daily chart, and we can see the vol compression or the vol crush clearly, um, and the price is moving to the top of our quarterly distribution towards the first standard deviation of real volatility. And you can see that it bounced off the third standard deviation of real volatility. Third standard deviation, real volatility. Second standard deviation, real volatility. These real volatility levels are what the higher time frame participants, it appears to me, from my empirical view of just looking at the chart, that that's what they're doing. And I can measure these ranges with my PT indicator and get an idea whether we're trading inside the range or outside. The standard deviation, you can see here was a 6 sigma. There's the one standard deviation of the quarterly. If I bring it down, there's 1, 2, 3. And what happens is you divide it by 2, multiply it by 2 because there's two sides, 34 and 34. 3 times 2 is 6. That's why they call it a 6 sigma event. Um, I can forecast where these outliers are, especially a Six Sigma event, and be all over that when the whole world is throwing their arms up in the air and fire, fire, fire. There's a certain number of very intelligent people like Mr. Simmons with Renaissance who are looking for these outlier situations to make their decisions on whether to place a bet in the market. So, with the knowledge of probabilities and with the PT indicator that allows me to see this is my distribution. Everybody does their own distribution. I understand that. This is mine, and it shows just a time series of volatility on higher time frames that we can individualize. Um, what I like about this is I can change my bottom oscillator to a time series that I would want to see intraday. So like having the daily chart up with the higher time frame, like a monthly, weekly, quarterly 45-day distribution, so that I can get my overhead feel for where the market may be going. I can change my lower time frame um, momentum to like a 30-minute chart on top of the daily candle, which will allow me to see intraday volatility even more granular than the daily volatility. And that helps me with my directional bias, with my knowledge of how the market responds to volatility, real volatility, as well as implied volatility. I'll show you that in just a second. Um, but give this a second to populate. Here we go. And we can see the vol spikes, and you can clearly see the vol crush going into this week as the price went from the third standard deviation up, actually since, July. This was the time to have gotten in. This was where the smart money was trading, traded it back inside the standard deviation, and they're taking it to the top. Now, what is this solid silver line? That is where the implied volatility option traders think the first standard deviation is. And let me show you that real quick, what I'm talking about. Um, the option world uh, is very mechanical, and they have these deltas that they come in with, and these delta or option strategies based on where implied volatility is trading to put their puts and call spreads and their vertical spreads or whatever their debit put spreads, whatever they're trading, zero DTE, but they're selling puts and calls to collect premium. And their goal is to have price stay inside that area, and they're bounding deviation levels of implied volatility, the first standard deviation or the second or the third, using deltas as a rule of thumb. So they believe the 16 delta equates to the probability of in the money, out of the money for that standard deviation, and then they'll put the appropriate um, vertical spread on for their suit their needs. I can show you on the my pricing sheet for Quick Strike that using the Black-Scholes model for the quarterly expiration, and I use Black-Scholes calculating price to volatility, you can come down and see the 16 delta right here is at 44.90, and Quick Strike is showing that second standard deviation level just a little bit below it at 4,500. So between 44.90 and 4,500 thereabouts, the option world is expecting that risk line to hold their spreads. So anyone trading that quarterly spread hopefully won't have to adjust their contract if that gets breached, challenged, and it starts trading below that. They will adjust their contract out, maybe to another at the money, in the money level within that deviation, or all the way out to the next level, the 2 3 or the end of the 3. And that is the implied volatility. So if we look at this level, we can see again 44.90, 4,500. I put the line on the chart, it's way up here at the second standard deviation of real volatility. So implied volatility is away from the real volatility. And if they're trading these quarterly spreads, the banks, the hedge funds, the sovereign wealth funds, they're going to be hitting it on these levels first touch. And how do I know that? Well, if I put up another chart, well, you can see on this chart that we just looked at these levels and saw the bounces, but I can also show you that on another ES chart. We'll look at a 30-minute. And I'll put the monthly on it. Need more days. Anytime that happens and you don't get the indicator, it requires more days because it's a higher time frame. Monthly is requiring a lot. And there it was. There's your first standard deviation, and they went right to it and turned around. There was not any indication that that level was holding any strong pin because they, like in the instance on August 11th this week, it was an iceberg. You could not see it in your open interest or in your volume. They came in after the fact and planted their um, risk there in a block trade so you couldn't see it on the order flow ladders. And that's what happens typically when you're seeing, a higher time frame like a central bank or a sovereign wealth fund or hedge funds or banks. They can come in with these block trades and we don't see them on our order flow ladders. But I have the calculations that I'm using for my perimeter ranges, and that was my monthly first standard deviation, and there was your touch. And that happens all the time. And like I said, I'm going from 1, 2, 3. So if I add the quarterly to this, I want to show you this so that you can really sink into what my distribution levels. And I appreciate the fact that everybody has their own distribution. Hedge funds spend a lot of money doing this, volatility funds. And I just sort of stumbled in on it and, you know, realized what I had after I built it, beginner's luck. Because I absolutely had no clue what I was doing at the beginning. I still don't. I'm learning as I go. I had a legal background for, most all of my life, 35 years, and worked in legal, not anything to do with finance. So I just grabbed a concept and built it out and realized after the fact what the hell I had just done. It's representing these higher time frames on my distribution of a bell curve. So there's your quarterly at 43.03. So here's your spreads. If they're going to be trading those vertical spreads, they're going to be wanting that to close inside that white line. That's your call wall. They don't want it to close outside that line by September 30th. Now we have plenty of time between now and September 30th, and this is the first touch of it on this very low volatility. So if volatility remains low going into that level, that would, lead us to assume that there might be a breach of it. And we'll see and look for the other time frames, like a monthly or a weekly, laid on top of it to see where maybe price would be wanting to go. And that's how you can see these prices coming in at these other levels. They do go to the higher time frame level, but they also respond to these intraday levels. And that's why I start layering, is that the right word? Layering the distributions on top of each other. And it really, really helps me understand where the market might come in and engage, like right there. Um, Here's the middle of the range. Knowing if you're in the middle of the distribution, knowing that these spreads, you know, they want them to expire worthless inside these levels. If it goes outside the level, we're inside a higher time frame one down here. So the larger time frame participant was never challenged, but the short term time frame, the monthly or the weekly, had to hedge the weekly. If they were buying weekly options, they got challenged, and they would have had to have adjusted their contract to the 3. You see how that works? They move their hedge out, sell premium down here, and then make money as it hopefully rolls up to the other side, coast to coast. So understanding their game, understanding real volatility, and having a manner into which we can add our custom distributions on top of each other, um, layering them in. Here's a daily. And what I like to do is I have the ability to calculate these on the open and the close. Here's a daily 3. We're wondering why it went to the middle of nowhere in the weekly, monthly. It will often go to the daily range. Like here was a daily confluence on July 13th to this so many lines on the chart. I have to look to see what they are. Weekly 2 with a daily 3. Touch and go back to the mean. What a great trade that was. So as Mr. Simmons, and here went right back to the next day to the 3 again and did the same thing. 2 winners, chicken dinners. As Mr. Simmons says, if you understand what the market is looking for and buy low, sell high, you might, and then know where the option traders think the standard deviation levels are. So we know what spreads that they will be deploying inside or outside the standard deviations using Black-Scholes. I think everybody uses their own little variation of that. So many different ones. This is my real volatility model. And, you can go back, I mean, and just look the eyeball test and see that for many years it stayed very well above the third standard deviation, hardly ever challenged it. The outliers were hedgeable for that reason. Here's another outlier. And once you get the concepts of these statistical levels, you'll know what to do when you get to one of these outlier levels, right? You don't need an invitation. Okay. And you can use your other tools with this, smaller time frames. Here is a 60-minute distribution on a 5-minute chart. Um, this is a good day trading, scalping method, especially if you can get an outlier below your third standard deviation and know how much distance you're expecting in a time period. I can customize my volatility range, and here I've customized it to tell me between 8:30 and 11:30 in the morning, which is the perfect morning session range. And I know that with my distribution, I'm expecting in low volatility 14 points. That would be like inside the 1 hour IB if it just sat there and zippered in a small range. Medium volatility 28 points, and high volatility 39 points. There's my custom time series estimation of where the volatility will be. And as you see here, between 8:30 in the morning, 8:30 right here, the lowest low, you calculate from the low going up. So as it keeps going lower, you would be looking for the higher calculation. Uh, if it reverses, if it continues going directionally, you would go from the high down, right? Either the high down or the low up. And run your range. Here was 28 points, and at 11:30, my dear, we were at 28 points. I'm not making this stuff up. The calculations do this, and the algos are pretty much creatures of ranges. And you can see it because they all kick in. Here's the third standard deviation on the 60-minute, right? It's like it is that simple. So I like to use momentum and linear regression, which I just had a sale for my package on Market Analyzer to help me see what the market is doing with the momentum and linear regression. And here is my template for a 5-minute Saint Mom, my super trend momentum. I call it Saint Mom. It's one of my favorite templates to run intraday. It helps me, with direction. So if you're having trouble with direction, especially because we get a lot of, conflicting signals during a trade session. Do we sell the top? Are we range trading? Do we have a chance for a breakout? What is the situation today? Well, put on your 30-minute volatility on a daily candle. Look for these higher time frame levels to trade to, like your quarterly or your monthly, weekly, daily blend, to get an idea where the spots are to focus on. Then you can look for that smaller time frame, maybe a 5-minute bar on a 60-minute distribution. And then if you want to wait for your confirmation, wait for that volatility momentum to come in. There's your 5-minute Saint Mom. Here's your 5-minute linear regression. And I have 5 minutes, very noisy, by the way. I have a blend, and I put my amalgamation of fresh. There it goes. there's my requirement that it be, all the little doggies be in confluence together. So I am working my way through this process of understanding these worlds and how they intersect and collide together. I use other tools, and I recommend that you don't just use my products blindly. I use the volume profile. I'm a huge volume profile proponent, especially these points of control and the value highs and lows on multiple time frames, daily and weekly in particular, to give myself a boundary. If I'm above the weekly point of control, I'm going to be with a long bias, right? Also, the delta will tell me on a quarterly or monthly or weekly or zero DTE contract what the option traders think the direction is. Sometimes they can get trapped on the wrong side because they're not on a higher time frame. They're focusing too narrowly on a zero DTE time frame, so it moves around a little bit more on them. But so get an idea of where they are going, and then put together a trade plan for yourself, realizing what you might be doing with the bias, where higher time frame support resistance might be, and where these opportunities are to come in and pick off some really sweet spots. However you want to do it, whether it's a 5 minute chart, coming in and, or trading to a specific volatility point, or you don't have to go to the absolute end. I probably would have been thinking about taking my profits at the third, standard deviation of a 60 minute. You have, take profits. I have found that keep your losses small and take your profits. You never go broke taking profits, right? So just, you know, come up with another method. I use VWAP as well, and I'll show you how I use the VWAP. You can get these tools from NinjaTrader, and the VWAP comes with a lifetime license as well as the order flow volume profile. But I'll put two instances on my chart. One set on the standard RTH setting, um, and the other one I will change it to a default 24/7, and I go back and change the displacement to 1. So the 24/7 is 1 displaced, and the RTH is just regular. And this allows me to have a secondary bias above or below VWAP, and also an great entry. I'll see where the higher time frames they'll be trying to place their orders around the VWAP, and I see where that's located on my distribution to give me some ideas of where the market might be coming to as well. And from my time analysis of where I know where my range is going to be within a certain time period, um, I can calculate how many points I can trade to during a given time frame of my choosing. I can change this, like I said, 11:30, 8:30 to 11:30, go to lunch, come back, set a different one from 1:30 to 3, um, or I can do the Globex session 1700 to 8:30 in the morning and know what the 1, 2, 3 is going to be overnight, and or set it between 8:30 and 9:30 in the morning, Chicago time, to know what the 1 hour IB is going to be. And that works really well also, the 1 hour IB, to set my standard deviation ranges for an intraday risk. If you can take your first standard deviation and then use that as your risk reward, and back test that, you might find some success, and at least expose you to that risk reward metric as the option traders are using it. So, very illuminating that the first standard deviation of the option world has nothing to do with real world volatility. And I would like to go back and say one more thing with that. Now that we know where they think the first standard deviation is, they think that if they're outside that, that's their risk. It makes it real easy for me to see that they're probably using the third standard deviation. So if they think that that's the one, they're probably using the three. So that would give me a heads up on where to expect to see order flow stacked in the CME quick strike. I can go back to quick strike and go to their volatility heat map and figure out where the volume and open interest is. So always know where the volume is, know where the order flow is if you can. So much of it is hidden, but maybe not for us, because if we know where these standard deviation levels are, we probably have a general ballpark of where the higher time frames coming in. Like I said, just open your eyes and look, and you can see that I'm very close with my distribution to what they're doing. Okay, and don't hesitate to experiment and put multiple time frames on your chart like I do. You get so much more value from it when you string these distributions together, and makes it easier to see where the order flow might be going. So play around with it. Don't hesitate to let me know if you have any questions. The Jeremy worked late yesterday, got us a new beta for Bloodhound 2.1 with a bug fix for the market analyzer. Everything's working great. So um, carry on with using Bloodhound 2.1 with the new NinjaTrader 26 and market analyzer package if you like that. Thank you so much. Y'all have a great day, great weekend.